Cole, thank you very much for joining us. Of those executives, ones who control parts of the economy and control a lot of jobs, no doubt, what kind of recovery do they see? Is it going to be fast? Is it going to be strong? Or is it going to be slow and drawn out?
Well, good morning, Brian, and thanks for having me on. So it is interesting. We did go out to about 300 of the premier CEOs, entrepreneurs, technologists, and their investors. And this is a group that is inherently optimistic, as you probably know. But the feedback was interesting. They came back saying they do expect a U-shaped type of recession, that they see it lasting for longer than 6 months, but that they do see a strong recovery after that period of time. So late in the year into 2021, a recovery happening pretty quickly across many of the technology sectors.
And what's the biggest concern about the reopening? Any way to gauge? Obviously, is it, as we talked about earlier, is it people simply fear to go out? Is it that there's no financing? Is it that there's no end-use customer demand? What are the big issues out there that you're seeing, Cole?
Well, as I mentioned, they're pretty positive, particularly when it comes to customer churn. Now, remember, these are software companies that have recurring revenues. They are seeing those revenues. That churn is pretty low in terms of those customers. They are seeing continued orders. Now, there's softness, no question. The majority are saying they're not going to hit the numbers that they're expecting to hit over the course of Q3 and into Q4. They do expect that to come back pretty significantly into next year, however.
How do they see it impacting valuations?
Well, there's no question, if you look at the stock market and the downturn that's been occurring over the course of the last month, that valuations are down in the public markets, and that obviously impacts private markets as well. So the expectation is that there'll be softness in valuations. That'll happen over the course of the next several months as well. Many of the investors, particularly on the venture capital and the private equity side, are patient, and they expect that deal flow will just slow down as opposed to accepting some of those lower valuations. But a number of these investors in particular have been through downturns before. They've seen what happens and what happened in the internet bubble when it burst. They saw what happened in the recession back in 2008, 2009, and they saw what happened to the economy thereafter. So they are anticipating some positive news coming out over the next couple of years when it comes to valuation, and they're prepared to wait for that.
What about the rest of this year as far as public offerings? Seems like there's no way to avoid a slowdown of IPOs, not to mention to which you just literally can't get on the floor of an exchange right now, Cole.
Yeah, that does make things difficult. And doing deals is tough. It's a question of doing net roadshows, doing everything virtually. On an M&A side, doing diligence via drones and via Zoom, just like we're doing right now. So deal activity both in the public markets and the private markets are going to slow. That means both M&A as well as IPOs. Some quality companies are still going to come out. There's no question that there are some countercyclical companies that we're currently backing and expect to come out over the course of this year. They're seeing some positive impacts from the work at home and the stay at home environment.